Good day and welcome to the Kerner Perspective Local Portfolio Report for the period ending 31 December 2023. This video really builds on the asset market and the big picture review, but also will refer to some of the holdings in the Kerner Flex Fund, and that'll be the fifth in this series of videos where we'll just unpack a little bit more on the positioning and performance of the Kerner Flex Fund. Okay, so looking very briefly at the more recent performance, you can see very erratic 1 month, 3 month performance from the underlying sub indices on the JSE. If you look on a 6 month view, interestingly enough, you'll see that it was really the local economy stocks, so the banks, the local industrials, listed properties, small and mid caps, that drove the performance over the 6 months to the 31st of December. And even if you look on a 1 year view, with 5% from the top 40, you can see that in large part that was being helped by the local economy stocks. I think a second important point is we mentioned in the June report that the JSE continues to shed listings, and that continued from then. I think there were another 20 odd companies that have delisted since that. And as you can see, from over 600 listings in the early 2000s, we're down to about 280. And this is important because our universe is ever shrinking. And that's something that obviously is a concern. But interestingly, it also creates opportunities. As companies prepare to delist, we often see opportunities in those counters. All right, then very quickly, we're just going to have a look at the overall Kerner Perspective portfolio, and it's important to stress that client portfolios differ from one client to the other depending on when those portfolios came in. So it's not to say that every client will hold these, and equally our fund obviously doesn't hold many of these positions. But what we're going to look at very quickly is just how differently the Kerner Perspective portfolios are positioned to the top 40. On the chart on the right hand side, you'll see the top 40 JSE top 40 bigger holdings. You can see the likes of Naspers and Anglos at 11 and 10% respectively, obviously fairly big constituents there. And then the banks being FirstRand and Standard, for example, at 5 and 6. But on balance of arguments, I think quite interestingly, many of those outside of those sort of big four are around 2%, 3%. And quite interestingly, 24% is allocated to the residual 20 shares. This is really just the top 20 holdings. So now illustrated on the left-hand side is the positioning of the Kerner Perspective holdings. Still on the right, obviously, is the top 40 index constituents. As you can see, the Kerner Perspective portfolio looks very different. The biggest holding there being Standard Bank at a little under 10%, followed by Naspers, which also represents a fairly sizable 8%. I think it's important to mention that these weightings are as a percentage of the actual equity portfolio and not the total portfolio. So the real number would be slightly lower. The Standard Bank 9.8 would probably be closer to 9% or a little bit below, but it'll give a pretty good idea. So I think one of the key differentiators is the fact that, as you can see, there are a lot more holdings that are more equally weighted, sort of 5, 6, 7, 8%. If you look at somebody like ABSA, for example, at 7, Aspen at 5, BHP at 7, and so on. So arguably a better equalized holding across some of the bigger holdings versus the top 40. And then also, as you can see, quite interestingly, some of those that are slightly off-center, the likes of ARK Invest and Argent, those are really all holdings that are not present in the top 40 index. So the bottom line is the Kerner Perspective portfolio, be they client portfolios or the Kerner Flex Fund, very, very differently positioned to the top 40 index. Some of the bigger holdings in the index that we don't hold would be some gold shares, the likes of MTN, Sanlam, and Capitec, to name but a few. But the bottom line is the The top 20 holdings represent or about 85% of the Kerner Perspective portfolio, whereas the top 20 holdings only represent about 75%, with the other 20 shares representing that 24%. So our tail is actually quite a lot smaller. You could argue it's a higher conviction portfolio. So the question may well be asked, well, why are we so differently positioned from the top 40? And really there are two reasons for it. The first one is we believe that capital should be deployed into counters that make fundamental sense and not just based on the index weighting. And one of the reasons for that is if you look over time, and this is a very busy chart and I don't necessarily want to unpack the granular detail, but what we're illustrating is the top 10 holdings of the top 40 index over a period of time from 2015, when SAB Miller was by some measure, together with Naspers, the biggest constituent of that index. It obviously delisted. Then you saw BHP, for example, and Naspers, also very big components, Anglos at a point in time, but various corporate actions have resulted in those weightings moving around quite a lot. So the first thing is that we believe the underlying constituents are very, very volatile, and we shouldn't allocate capital according to that metric. And secondly, as you can see, often 40 to 50% of the weighting of the top 40 index would be consolidated in 4, sometimes 5 shares. And you can see it from 2015, 45% in 4 shares, in 2019, 50% in 4 shares, 52% in 2021, and so on and so forth. So the bottom line is it's really not a great proxy for what's happening in the South African market. All right, then just having a quick look at some of the counters. And we've basically structured this in order of the size of the portfolio holdings, starting with Standard Bank. As you can see, Standard Bank's had a very good recovery from the COVID lows. I think in terms of the South African banking scene, probably the most consistent performer on the upside in the recovery. And we're going to just spend a little bit of time unpacking the Standard Bank story and why it is such a big holding in client portfolios. And I would argue this is pretty much across the board for almost all clients. Okay, so again, a busy slide, but the gist of this is that if you have a glance at Standard Bank, it obviously operates as a holistic financial services group. It's not just a bank, for example, with Liberty and asset management businesses and investment services businesses, for example, in Nigeria. So a very big diversified group, essentially operating in a variety of clusters. So you've got investment services, then you've got private clients or high net worths, you've got business banking and CIB, if you look at the classic banking model. And just a couple of numbers here, headline earnings for the group, for the half year for the full year was at 21 billion rand. This is the half year, I apologize, to June. Headline earnings of over 12 rand a share, and a common tier 1 equity ratio at 13.5%. So in anybody's book, this is a big business. As you can see, it's got almost 18 million clients, 1.5 trillion rands worth of lending, and a balance sheet of approaching 3 trillion rand. Okay, so what do we like about Standard Bank? As we say, it's diversified. It's got a variety of businesses. It's got a great balance sheet, and we're going to go through some of these in a little bit more detail in a second. It's got a great African footprint. We believe in the story for Africa. If we look over the next century, we can see a lot of exciting prospects for Africa. We believe that digitization, and they've been in that sort of J-curve hockey stick for some time, but we believe that digitization and technology is really going to help to drive those cost-to-income ratios down, and that will boost and sustain earnings per share growth, even in a difficult economic environment. It has a great history of delivery, and it's actually a lot more resilient than you would expect from a company that is arguably geared to an economy. And then finally, it's got a great shareholder base, and we believe the ICBC strategic relationship and shareholder relationship is a very, very strong incentive. Okay, so really a lot of this is quite fragmented, but it's got an incredibly strong and conservative balance sheet. As you can see, if you look at the lending, so that's advances to clients, from loans to other banks, home loans representing almost 30% of the book. Interestingly, very little in the unsecured space. If you look at card and personal unsecured lending, not even 10%. And obviously corporate and sovereign has become quite an important part. Also very, very well diversified from a depositor point of view. I think there's 1.8 trillion rands worth of deposits, everything from call and current accounts all the way through to longer term deposits and NCDs. And then finally, if you just look at the advances growth over the last while, as you can see, home services, which is home loans, up 6%, but government, corporate and sovereign was quite a big driver, with card and unsecured personal fairly small, obviously reflecting the difficult environment. So we believe they are very, very good balance sheet managers and very prudent lenders. The balance sheet obviously can manifest itself, or does manifest itself, in what's called the book value per share. There's not a big difference between book value and tangible book value, but as you can see, book value per share as at December of 23, probably approaching 160 Rand. If you take a share price of 200, that's really not a very big premium to book value, and we believe that book value to be quite solid and secure. As we said, Africa very much a growth story, an exciting prospect. You can see in that bottom right-hand chart the African region's contributions, strong growth in the contribution from the African operations. The last results, the June results, for example, did flatter a little bit because of the ICBC contribution, but that's obviously in the UK. But nonetheless, it's really exciting to see the African operations getting some real momentum. Then the bar graph above that and the chart to the left are really just different illustrations of the high growth that is happening in Africa and is expected to happen in Africa. If you look, economies like the Ivory Coast, Zimbabwe, Mozambique, Kenya, Namibia, all growing well in excess of 5%, and we think that there's some momentum there. And obviously, with 3 trillion of assets and 1.5 trillion, give or take, of loans, Standard Bank is by a little measure the biggest bank on the African continent. Right, technology we believe is going to help to drive costs down. A lot of people were very unhappy when Standard Bank closed quite a few branches, probably about 2 years ago, but that is to be expected. The reality is that increasingly customers are engaging digitally. Servicing those customers digitally is a lot easier, and it's a lot more cost effective. What we're showing you on the top left and just below that is effectively how Standard Bank has accelerated the spend on technology. So for example, IT costs growing by over 10% on a 5-year, 6-year CAGR, versus staff costs at only 3%, and overall costs basically flat. And this is telling you the story that they are effectively saving and investing. So by investing in technology, it generates long-term savings, and you can see it there in the cost to income ratio trend that is going down. And we actually believe that downward slope is going to accelerate, and we would very much like to see it closer to the 50% mark, which we think is achievable. And I think it's a very important but a powerful motivation, because another 1 or 1.5% improvement in the cost to income ratio has a very, very significant effect on your earnings growth. So we feel technology is really going to help to drive earnings growth up, and obviously the cost to income ratio down. All right, Standard Bank has a history of delivering, and if you look at those 3 bar graphs on the right hand side, the lighter blue and the sort of yellow color, those are forecasts, because as we record this, as at late in January 2024. The December 23 numbers haven't been released yet. Forecast there 24 Rand 50 and a dividend of approaching 15 Rand. We think those are probably, you can almost pen those in, and then the forecasts obviously become a little bit more vague thereafter. But interestingly, that little dotted line is effectively the 12-year trend, and as you can see, very, very solid earnings growth and dividend growth obviously following suit. I think if you look at the CAGR earnings and dividend growth over the last 5-6 years, fairly constant on a normalized basis at about 10%. What we did here was, if one looks over time at Standard Bank, very often it trades around an 11 historic multiple. And what I did here was just try to illustrate the theory, because obviously if you look at you know, the GFC period, or you look at the 2020 COVID-induced impairment rises, etc., you know, the earnings do, at least the reported earnings, do look a lot more volatile. So what I've done here is I'm trying to illustrate how over time Standard Bank tends to trade very much where it should, in inverted commas, around the 11 historic PE multiple. So what I've done is I've got the target price, which I've really calculated it by taking the 3-year rolling earnings per share average and timing that by an 11 multiple, and then the red line is effectively the Standard Bank share price. And as you can see, it tends to move quite closely. And really what I'm trying to illustrate here is, if you believe that an 11 multiple historic is right for Standard Bank, it actually quite often trades at that level, with the anomaly being the current period, where obviously the share price has relatively underperformed in spite of a strong operational performance. Okay, so with all of this, the question is if we say it's cheap, how cheap is it? Our fair value estimate as at the 31st of December, sorry, that should be 2023, was 264 Rand per share. That's based on an earnings estimate of around 24. Market's expecting slightly more than that and a PE of 11. So it's really 24 times 11, you come to circa 264. That implies around 30% upside from the current levels, slightly less than that from the December year-end figure. Based on EPS of 24 Rand and earnings dividends of 14.50, that puts Standard Bank, as we speak, assuming those numbers are going to be delivered, at a historic PE of 8.6 and a dividend yield excluding DWT of 7%. If you look to the end of 2024, which is what we really should now be doing, the market's looking for earnings in the region of 26 Rand, slightly more than that, but we've trimmed it back, and DPS of around 16 Rand. That puts it on a forward PE to December of this year of a very, very ridiculously cheap 7.7 multiple and a forward dividend yield of 8%. And effectively, if we put those numbers on an 11 multiple, we get a fair value target of 286 Rand, which gives you around 40% upside. Now, some people may say, yeah, but we need to temper our optimism because rates are high and impairment rates are going up. But I think the important thing is that what we were trying to illustrate is that even when interest rates are high and when economic conditions are fairly tight, etc., and competition is around, that Standard Bank has proven itself able to deliver that. And we feel that that sort of average earnings growth of 8 to 10% is realistic in the current environment, which means you're really buying this thing on a PEG ratio of under 1 times. And then finally, interestingly, Standard Bank is blessed with a very, very strong shareholder base. The GEPF owns circa 15%, but the important shareholder here, of course, is the ICBC from China, which in itself is a giant of a bank, and very importantly is a strategic partner into Africa and creating two-way trade. So we think that that's a really positive development. If you just look on average, the South African share register is about 50%, and then the rest of the world including China at about 50%. So solid institutional shareholding base, underpinned by a few important and supportive strategic investors. All right, we're going to go through the rest of the holdings in as quickly as we can. Obviously, Naspers had a real wobble towards the end of last year, with the Chinese authorities once again getting their boot on the throat of Tencent and others. It has subsequently recovered a little bit. What we're seeing is a very deliberate action on the part of management to unlock that excessive discount. We still remain fundamentally positive on Tencent. Yes, there is some anxiety around the actions around gaming and curbing spend and time, but we would urge you to remember that Tencent itself is a maturing business, and it has a lot more business silos, or you know, it's standing on a lot more legs than it used to. So we're comfortable with Naspers. We think a 30–40% discount is excessive for this quality asset base. All right, BHP Group, and of course BHP, as we said, was one of those where there was a corporate action. The PLC structure was collapsed. That happened almost 2 years ago. As you can see, it's up from there. Late last year had a little bit of a sell-off with commodity prices coming off a little bit, but yeah, BHP is a good asset, but I think one of the problems is the increases in prices has proven a little bit insufficient to offset the cost pressures that miners are experiencing. But you know, it's probably our third biggest holding, generally in a space where we're very underinvested in commodities. The reason being, it's just got great tier one assets, as we've previously discussed, and we think that this one will be left standing long after others are carried out. Right, then the other one is Absa. I think Absa was hurt by the higher interest rate environment in South Africa more than the likes of Standard Bank. Also, I think the departure of the CFO added more turbulence to what has been a fairly volatile senior management team, but it's just too cheap. You know, this company is sitting on a dividend yield of approaching 9% forward. You know, PE ratio of under 8. It's just too cheap, and we think that the upside in Absa is very, very significant from these oversold levels, and you can just see the extent to which it has underperformed Standard Bank. But it's really a case of when the tide comes in, this one is going to give you a double bonus because of the very low valuation. In spite of the fact that we've actually offloaded Shoprite, in fact, in our fund, we are completely out of Shoprite right now. In spite of selling it off, it is our fifth biggest holding. It's just had a phenomenal performance. As I record this earlier today, you know, they came out with a trading update for the 6 months to December in terms of volume guidance or sales guidance, you know, up 14%. They really are literally and figuratively eating their competitors' lunch. They are really doing incredibly well, and really just a power to be reckoned with. So the only problem we've got, we love the business, we love the management, we love everything about it except the share price. The multiple is just too much. Right, then Reinet Investments, interestingly, has become a very significant part. And quite interestingly, Reinet has done, as you can see there, very, very well in spite of the fact that British American Tobacco, which was, you know, if you go back to when this was birthed, was 85–90% of the portfolio. It has really done spectacularly well. Another one of those discount to NAV plays, and increasingly Reinet is obviously a pension insurance corporation play and less of a tobacco play. So I think that our sixth biggest holding, we're very happy with the performance and the underlying assets. Then Aspen, if you look over the last 5 years, it's really just been clawing its way back. It had a rally in 2021. Obviously, the COVID scenario helped that a little bit with their manufacturing. We just believe this is a much better business today than it was 5 or 10 years ago, and yet the share price is languishing. We do understand that it's in a competitive space, and the pharma industry generally is unloved in the world. But we think, great offshore earnings, strong cash flow, good leadership, great products, and fairly high visibility. So we think Aspen is a good one. And as you'll see, it's done very, very nicely for us. Over a year, it's up to December, it's up almost 50%. So we're very happy with the performance, very happy with our holding. All right, then Ethos Capital, we spoke in some length, or at some length about them at the June half year. We remain very confident on the underlying portfolio. We believe that management and the board have a plan to unlock value that is trapped. It continues to trade at over 50% discount to what we believe to be a fairly conservative net asset value. For us, this is just one of those no-brainers. The share price is a source of, I'll be honest, great personal frustration, but I'm not worried about the company. I believe that this one will reward shareholders, especially from these suppressed levels. Then Remgro, you'll probably remember, for those who've been with us for a while, Remgro was a company that we were quite unimpressed with a few years ago. They weren't doing much with their portfolio. In fact, if you had to be honest, the last big thing they did was probably, the BHP FirstRand transaction. But man, they really have unlocked huge value. Obviously, with the RMH FirstRand unbundling and distribution, value unlock there. And they've been very, very active with the delisting of Mediclinic, as well as the Heineken Distell deal. So increasingly a private equity play. We're not unhappy with that. We think they've got their mojo back. You've got a great portfolio of generally defensive businesses with, the Distell portfolio, for example, an incredible brand portfolio that does well in all environments in South Africa. So we're very happy with Remgro. For a lot of clients, including our fund, we added it fairly recently, probably around the time we saw the indications of the value unlock strategy with FirstRand. And we're very happy with the share price performance of late, and we're also very happy with the underlying portfolio. Yet again, a net asset value play. So if you look, across the top 10, you've got Ethos, Reinet, Remgro, all, and Naspers for that matter, all NAV plays, and all of them actually trading at reasonable discounts to NAV. Right, then a fairly recent acquisition. So really the 5-year chart doesn't mean awfully much to most of us. Fairly recent acquisition is what's called TFG, known as the Foschini Group to some. We spoke about them before. We believe they're an incredible combination of entrepreneurial spirit while also being very, very prudent. Of course, both the UK operations and the Australian operations are very significant contributors. So you've got a little bit of a rand hedge element if that's what you're looking for. Yeah, it's been quite volatile over the last while. Obviously, load shedding and the negative mood towards retailers has seen it vacillate quite aggressively through 2023. Share price as we speak over 110 Rand, looking as though the market's seeing it for what it is. So we believe that this one is very, very well placed, very, very smart from a deal making point of view, and just other interesting opportunities. For example, if you look at the TimeBank kiosks that they're rolling out in some of their stores, just very creative and very solid retailers. Then Anglo American, I don't know if you remember, but around 2% of portfolio, so fairly small holding in our world. And Anglo just seems to be coming in for a soft landing. The current share price at 4.39 or as at year end, up on where it was 5 years ago, but not much. And that's one of the problems with commodity stocks generally. They tend to be cyclical in their profitability often. When market conditions are turning south, the profits fall and the earnings per the PE ratios rocket. So arguably the right time to buy this is at the beginning of the cycle, not at the end of the cycle or halfway through the cycle. So we think Anglo's is probably fairly undervalued right now, but we don't think it's going to do awfully much. And one of the problems, of course, is, De Beers has had its fair share of problems. You've seen that they reduced prices with the last site sale quite significantly, which is the first time they've done that in a considerable time. So Anglo's having a few challenges. Then KOP, also a fairly recent acquisition. We probably started getting in around R4.50. Share price has been absolutely hammered. We spoke about it at length in the June presentation. If you like, go back and watch that. But great underlying portfolio companies, good balance sheet. Safripol obviously is having some issues because of load shedding and polymer prices and chemical prices, but that will restore. Those margins will normalize. PG Bison, we think, is trading well. Unitrans are very smart in terms of getting out of loss-making transaction or contracts. And then the other businesses like Feltex and so on also trading very, very well. So we like the underlying components, and we think that this is one of those sort of really unloved small caps that could surprise quite significantly. And as a company, we're very happy with the fundamentals. Once again, just frustrated with the share price. Then City Lodge, obviously, COVID absolutely decimated the tourism sector. They did a rights issue. They're busy building themselves up. We believe in the story. We believe in the management. We've really just got to wait for the share price to recover. Fortunately, for the rights issue and subsequent transactions, we've managed to, obviously see an average price considerably lower than that chart would suggest. Then Richemont is quite an interesting one. We mainly increased our Richemont exposure for certain clients through the Richemont warrants, through the options. More recently, obviously, it got going courtesy of a bit of excitement around luxury goods. But still, if you look from the restructuring, the inward listed EDR structure, share price has come off, but it is fighting its way back. We think this is a good business. Obviously, quite a lot of cash still sitting at the center, very cash generative. A good business, but it tends to be a lot more volatile than you would think, selling to incredibly affluent people. So fairly small holding, one we will watch, and if the opportunity presents itself, increase. Then Argent, we spoke about last time as being the poster child for how companies can disappoint you for a long time, and then suddenly everything kicks into gear and people stop seeing it as a sickly problem and start rewarding it for the good work they do. It's been sort of largely trending sideways. Still, if you look at it from a net asset value point of view, on a PE, very, very cheap. It's one of those we don't believe will be listed too long from now. So probably, we're not going to add to them. It is quite illiquid. It doesn't make sense to pay up and chase, especially because, for most clients, we were probably in at R4 a share. All right, then African Rainbow Capital, we hold them in the fund quite significantly because we think there's a unique opportunity here. But for a lot of clients, when you have the likes of Ethos, a significant holding, some may feel investment holding companies trading at deep discounts with private equity may be a bit excessive. We do hold them for some private clients, and we probably will, on weakness, add a few to other client portfolios. But it's a really good story. Underlying, obviously, Rain is a telecom play. We'll look in a second at what some of the telecom stocks have done, but Rain, we think, is the leader in this sort of fees sort of in a fall fight. Time Bank is doing very, very well. It actually just reached profitability, and Time Global is very exciting. But interestingly, just a really exciting portfolio of financial services businesses, and we like the crops business, which is agricultural commodities, very much as well. So African Rainbow Capital, exciting story, also trading at a 50% plus discount to net asset value. Then Prosus, very much just like the Naspers story. Our decision to hold Naspers and not flip into Prosus was the correct one. Offshore, when the share price got hit in 2022, we did add, because obviously we don't have the Naspers option there, and that has worked out well, but generally we would prefer Naspers. York Timber is one of those companies that screens value, trading at about 20% of book value. A little while ago, the new leadership team and strategic shareholders drove a rights issue. We believe it was fairly opportunistic to increase their own shareholding and rebalance the register. The bottom line is that the profitability scenario, when the extension of the harvesting, to over 20 years, once those harvestings start happening, you're going to see this thing become a massive cash cow. But in the meantime, it's just really trending sideways. But good value, we're in with good other shareholders, and we believe that this one will make money. It's just going to require a bit of patience. Then Sasol is really probably most people's perennial disappointment. More recently, it has come off end of last year, and subsequent to that, we spoke about it at length. It's really earmarked for sale, but it is still a profitable business based on the Synfuels contribution, and it seems silly to give it away at 200 Rand or less. So we're going to hold it and earmark it for sale. Another one that we've actually significantly reduced our holding. If you go back maybe 2 or 3 years, Discovery would have been in the top 5 holdings. We've reduced that significantly. We were quite fortunate early 2022. We managed to offload about half our holding for clients at around 180 Rand a share. We did another tranche of those in the 150s. Share price still around the 140 mark, 135. Also earmarked for sale. We think that the gears are starting to slip in this model, and if you're looking for life office exposure, we think there are other better bets out there. Then very quickly, just a few other peripheral holdings that we haven't discussed here. FirstRand very much was our bank of choice, but it has done its thing, and the base is fairly full. BATS, we spoke about Reinet, we prefer BAT. Bidvest, Bidcorp, both good businesses. Bidcorp, I think, better so. Mondi, a really good business, and one we are increasingly looking at. In fact, we took a small position in our fund a while ago. Then Sanlam, Coronation, Old Mutual, all market proxies, geared market proxies. Obviously, Old Mutual is more of a value play than Sanlam, and Coronation gives you just that geared asset manager exposure. Then Bell and Wilson Bailey, both good businesses, and both looking fairly cheap right now. All right, just again, a very busy slide. If you take a 6-month view, you'll see some of the best performances, fortunately coming from some of the bigger holdings. Shoprite, Standard Bank, all up over 20%. Some of the weaker performances, things like Sasol, which fortunately are quite small, and even the likes of Anglo American down 12. It's a small holding. I'd say one of the disappointing performances here, obviously ABSA down 3% over 6 months. And if you look at somebody like ARK Invest and Ethos, also somewhat disappointing considering what they had been doing. But on balance of arguments, I think most of our bigger holdings actually did quite nicely. Naspers, this is to the end of December. It has subsequently recovered, but yeah, it's good to see some of the other plays like TFG also stepping up to the plate. And then on the longer term performance, as we said, Argent we were very patient with, and it rewarded us. If you look over 5 years, it's the standout performance, up 200%. Naspers obviously has been a good performer, and then Reinet, as we discussed, it really has done very well. And if you look over 5 years, Standard Bank quite disappointing, only up 16%. But I think that, as we've unpacked or illustrated, actually is more of an opportunity than a risk. I think some of the counters we think we could probably hold more of. Bidcorp is a great business. Strong international footprint, strong earnings growth in dollar or euro terms. Mondi also a very good business. but we think Old Mutual probably is another one that we could add. All right, just a few of the things that we don't hold. Firstly, if you look at the platinum sector, this is the 10-year chart on Amplats, and what we're trying to illustrate is, Amplats went from 400 Rand all the way to over 2,000 Rand, and it's given all the way back to 800. We fundamentally don't like being invested in businesses that are that volatile in nature. Of course, we've seen weakness in things like City Lodge and KAP, but we would argue that the underlying businesses are not as volatile as maybe platinum producers. Equally for the likes of Anglo Gold, if you look over 10 years, the share price has doubled, but it's been a very, very bumpy ride. So we consciously sat out of these. Of course, another one, AB InBev, when it was making its play for SAB, decided to list here. We sat that one out. I know there are some high-profile value investors that have this as one of their top 3 holdings. For us, still too much debt, too difficult to move the needle from an earnings point of view. And yeah, going to probably battle to grow the top line and drive the earnings per share growth, particularly if rates remain sticky for a little longer. Then a company like Clicks has done spectacularly well. As you can see, over 5 years, it's gone from around 200 Rand to, let's call it 300 Rand a share. We think it's a brilliant business, well-placed, well-positioned, execute incredibly well. The problem we've got is the valuation. 30 multiple for a business that's growing its profits by early double digits. It's just not, the price is just not right. Gold Fields has been one of the better performing gold stocks, but the fundamental story remains that commodity producers are volatile business models. Harmony Gold is another one. Then MTN, quite interestingly, done very, very little. Share price almost exactly where it was 5 years ago and lower than it would have been a decade ago. So we thank you very much for watching this. We hope that it was of value. We know that we went through a lot of those slides quite quickly, but we trust that you got value out of it nonetheless. As always, you're very welcome to reach out to us should you have any questions or comments. Thank you and speak soon.